Hi everyone, welcome to another show of Connecting Insurance. As you can hear, today it's in English. My guest is not new, Ollie. Welcome to the show.
Thank you, Nick. Yes, third time to the show or to a show with you. So happy to be here again.
For those of you who don't know Ollie yet, Ollie, why don't you just very briefly introduce yourself, and then I'm kind of setting the scene for this show.
Absolutely. Yes. Hi, I'm Ollie. Hi to everybody. I'm an insurance veteran. Been in the insurance industry for quite a while. I've been starting as a consultant. I've done a lot of consulting for insurance companies. I've been a chief risk officer of a reinsurance company. I've been a multiple co-founder, and then I've been a CEO at WeFox, which some of you might know as the biggest European insurtech. First for WeFox Insurance, which was formerly called One Insurance. The Germans might remember, and later for the entire WeFox operations.
Awesome. And for those of you wondering why this is in English and why, only a couple of days ago, Ollie and I are talking again. To set the scene, Ollie and I spoke recently in German about providing switch products to insurance companies, brokers, and MGAs alike as a white label. We got quite a few requests of doing it in English, and we're very happy to oblige. It won't be a recap of what we've spoken about. So for anyone listening in who's also already familiar with the topic, we can just wholeheartedly invite you to listen in and give feedback, because this is kind of a progression of it's also a recap, don't worry about it, but it's also a progression of what we're learning, discussing with all of you out there day in and day out about this cool opportunity. But why don't we just kind of jump in? Ollie, let's talk about Switch. What is it and why does it matter?
That's a broad question. Good to start with, and stop me if I'm getting too lengthy. So Switch is a tariff generation or structure that I guess we didn't invent at One Insurance or WeFox Insurance. It was there before, but we kind of probably gave it a little bit of a twist. It basically based on two facts. Number one, if you want to grow as an insurance company, you need to tap into the large lines of business, LOBs as we call it, right? So motor is by far the largest in P&C, and then comes private liability, homeowners, household insurance, that kind of stuff. I mean, there's great examples, don't get me wrong, for niche products. Bought by Many is a great company in a wonderful niche. But if you really want to become a big player, you need to tap into the mainstream lines of business. Let's say those mainstream lines of business tend to be distributed amongst competitors, right? Everybody has a motor contract because it's obligatory. Most people have a household or homeowners insurance or private liability. So in order to grow in these lines of business, you have to take business away from somebody else. Rarely a customer is a first-time customer to one of those products. Get Safe in Germany is somebody who really captures the first-time customers a lot, but it's not easy to find. So this is the first building block, and then the second building block is we said, if you want to steal away business from competitors because it's somewhere already, you need human sales capacity. People are not insurance is not a high involvement product, so you need and Nick has this nice expression of you need people with authority in insurance on customers. And if you have authority in insurance about customer, you can actually move the customer from insurance company A to insurance company B. So, one, we need to steal business away from others. Two, we need human persons to do this. And so we've decided that WeFox or One Insurance that we want to build a product that is specifically designed for bringing customer from insurance A to B extremely easy as possible for human salespeople. And this is how it's built, right? It's built on an easy to tell story to the customer, very easily told. It's legally safe, so you don't misconsult a customer. And it's very easy to calculate and conclude because it's based on a very limited amount of questions you have to ask to the customer. So you save about 90% of your time as a human salesperson when selling it to a customer. And how it does it is, the most complicated thing in calculating and concluding a P&C contract is asking all the questions and then basing your actuarial pricing, your technical price on the answer of the questions. And so what this tariff does is it gives credit to the actuary before you. So the actuary of the current insurance of the customer, it gives credit to this person and says, this person will have done his job or her job. And so we base our price on their price, and we just adjust it by a discount or top up or whatever. But we basically believe that the actuaries are doing their job no matter what insurance company they work for. That's actually not 100% true. We actually had to learn that from data. So it is important to find out in which segments of the market most actuaries in most insurance companies do their job, and in some segments of the markets, it's a political decision by insurance companies that the actuaries don't do their job properly. So we call that underpricing. So we actually ask for a lower price than we should actually ask for because we talk ourselves into secondary effects like cross-selling or a lengthy customer journey with the customer lifetime with the customer. So there's political things, but it's not the fault of the actuaries. They typically do their job, and we have to rule out the segments of the markets where actuaries are not allowed to do their job properly.
And so what's the customer promise? What's that easy to tell sales story you were referring to?
Absolutely. So we're talking about customers who already have a product in that line of business. Let's say it's a private liability. Everybody should have a private liability, by the way. If you don't have, get one. So everybody should have a private liability. Let's say you're a broker or sales agent. Your customer is sitting in front of you. He or she has a private liability insurance with another insurer. And so number one question you ask: do you have this private liability insurance? Customer says yes. You say, are you happy? Customer typically says yes, because I didn't have a claim yet, so nothing to worry about. And then the story is, okay, I can actually make this better and potentially even cheaper for you, or cheaper and potentially better, depending on if you want to play the price game or the quality game. But it's basically what you have, but I make it better for you. Is that something you can live with? That's the story, basically. So you don't have to go through terms and conditions, 17 pages of terms and conditions. You tell the customer, I get you what you have today. I get it to a better and or cheaper. And that's basically the story. Can tell it in 10 seconds.
Okay. And, I think one calibration that I've seen in the market is basically better or same conditions at 5% discount.
Yes, that's riding the cheaper argument. I think we're going to touch upon people asking, doesn't make me look like a cheap shit? Mm-hmm. And so you can obviously change the story and say, I can get better coverage to you, or better conditions, or more digitized, whatever, at the same price, so that you don't seem to be a cheap shit offerer. So that's you can tell the story either way.
Okay. And what's the mechanic behind it? Because let's say if you're offering the same at lower price, or at more at the same price, how does it work? Aren't you then just eroding your own margin? How does this turn out to be profitable for you?
Well, you're not eroding your own margin, you're eroding somebody else's margin. And that's why it's so important to determine the segments and the current insurance companies you want to steal the business from. Obviously, you don't want to steal from already unprofitable insurers. I mean, there's some insurers out there, we all know them, that try to buy market share by staying below the price of all competitors. You don't want to undercut those competitors by 5%. So it's extremely important to get your underwriting right. Okay. And to tap into pools of customers that are profitable today. Typically those are customers that have stayed with their current insurers for quite some time. All of us portfolio managers know that the longer customer stays, typically the more profitable he or she is. So you try to steal those and not the ones that switch their insurer for price reasons every year anyway. So there, you with the underwriting rules you can then determine them yourself. You determine, what segments you tap into, and obviously the more profitable the segments are that you tap into, the better will your loss ratio, combined ratio be.
And I think one of the things that I at least am kind of learned through this journey was that the average, let's say, for most product lines, not everyone, all the tariffs usually have a worse, let's say, value. It's premium for coverage tends to get better as modern products come to market to win over new customers. It's not for every line of business, but that's one of the reasons why this also works, I guess, because they just have higher margins.
Yes, that's exactly it. Typically, what we found out is that with undercutting an old tariff of a competitor by X%, 5%, let's say, gives you a much higher premium volume per the same risk than pricing it bottom up as at least as a low or no brand. There might be brands out there like Allianz in Germany or AXA in Switzerland or Generali in Italy that might be able to have to secure a higher price in new business than in the switch tariff, but most insurance companies don't have that strong of a brand, and for them, it's more they receive higher premium volumes for new customers compared to them pricing the customer bottom up and realizing that they don't have the biggest brand and they can't go in with the highest price. So typically even in very profitable countries like Switzerland, new business is much less profitable than old business. It also has to do with markets are becoming much more transparent. We have customer tests, we have aggregators comparing prices every millisecond. So I mean it's become more more visible for everybody. So you can't uphold the large profit pools from 20 years ago.
Yep. No, and I think I don't know whether that number is correct, but I think someone at Allianz told me that they did it in a market on price comparison site, and they said their brand kind of carried 7 to 9% uplift.
Yeah.
But that's obviously much. I think you've mentioned at some point something in a double-digit price difference between your own new tariffs versus the kind of switched ones. So that's kind of how it works. It's a little bit, I think, my comparison is it's similar to mobile phone contracts, right?
Yes.
That's kind of a similar thing, and it's just the fact that with customers being maybe not that a bit lazy or not that interested in your product, there is a strong economic incentive to subsidize the new customers with the old ones. It's just what you'll do as a manager then, I suppose. If you're now thinking for which lines of business does this work, or for which doesn't it work?
Well, it definitely doesn't work for lines of business that have old age provisions, right? If you think full health insurance or life insurance, term life insurance, which stay at the same premium volume throughout the lifetime of a customer, although obviously the probability of dying is much higher at age 70 than at age 30. Those tariffs build reserves over time, so over customer lifetime. And you can't go into a tariff at age, let's say, 60 of a customer that has been priced when the customer was 30 and has built all those provisions for the older age, and you enter it exactly at the point where the probability of dying increases sharply. That doesn't make sense. So it needs to be a P&C like tariff. Could be additional health. Dental insurance is typically calculated like a P&C contract on a yearly basis. So with aging population, your price increases typically. So that's basically what I would exclude from switch. And then switch obviously is better the higher the existing penetration of a product, because the more customers already have that product, the more customers are eligible for a switch. So motor is great because everybody needs to have it. It's mandatory. Household, private liability, homeowners is good because a large portion of people, like 90% plus or so, have it. It's not so good for e-bike or so, where the penetration is already or is still very low, or pet insurance in most markets except Sweden, I guess, or so, is also much lower than 50% or so in many countries, France or Spain or Italy. So that's not as good, because the probability of meeting a customer that already has a pet contract is much lower than meeting a customer who already has a motor contract. So that's a thing. Then if the line of business is generally profitable, then cutting 5% off the profit is easier than if a line of business is generally unprofitable. So that's a plus. And I guess high complexity in the underwriting process. So in motor, whoever has bought a motor contract recently, people are asking you up to 60 questions. I go through the aggregators and want to compare motor contracts. I have to answer 60 questions. And one of the beauties of the switch contract is that it shortens this number of questions you have to ask, because it doesn't have their own actual pricing to a number of 6 or so, right? So you say 40, 55, 54 questions. So the more complex the underwriting process is in the normal business, the bigger the advantage of the switch contract. But it's also possible for easy to underwrite products, but it's more attractive. The difference is bigger in a motor or health contract than in a private liability where you only ask 5 questions anyways.
Fair enough. And I mean, you've kind of alluded to it already, but by your own preference by type of distribution channel, how would you rank them from kind of best to worst?
Good question, and that's a bit based on my own experience, and I have to say they're absolutely not a affinity or direct salesperson. I'm a broker, agent, sales force channel. I still believe in the human touch in distribution. So my ranking might be due to the fact that I'm just an idiot in direct online sales, but I'd rank anything with, as you nicely put it, Nick, with an authority in insurance issues with a customer. I rank that higher. So tied agents for me is the best sales force. They typically know their customers personally. They have authority. If they go to the customer and say, I advise you to switch from A to B, the customer typically says yes. It's like going to the doctor and the doctor tells take drug number A, drug A. You typically don't say, hey, what about B or C, or couldn't I take D? No, I mean, I believe my doctor. He's after all, he studied. So agent sales force is a great thing. Tied agents, brokers are great. And then I would rank a bit lower, banks, I guess, which I think have some sort of trust with customers, but potentially not necessarily so much in insurance questions, more in savings or loan or so. Same with employers, I'd say. Surely I would believe my employer more than anybody else on the street, but would I believe him or her in insurance things? I don't know. So that's kind of the middle. And then affinity sales partners and online, I'd rank least or last because I personally don't see the authority. But probably if you ask Geico in US or I know Direct Line or Hook in Germany, they probably feel they have the authority, and they probably have it much better than I could ever do it. So maybe I underestimate the authority those guys have on their customers.
Okay, but basically, and I think that's the beauty of it, is embedding switch for someone or with someone who's already earned that authority seems to be, rather than trying to earn the authority yourself, is kind of one of the twists here. Okay. Now, if you think about, now this works in Germany, and I think you've also started to deploy this in Switzerland. Yeah. From your point of view, which other markets? Let's start with Europe. Where else would this work, or conversely, where wouldn't this work? Whatever is easier, whatever is a shorter list.
Yeah. Let me start positively. So I do think it works well in countries with a generally good profitability. Switzerland obviously is perfect because it probably has the highest profitability of any markets in Europe. I do think that France, Italy, Spain have good profitabilities. Netherlands is typically okay. Belgium is okay. The Scandinavian countries are good. So high profitability helps obviously. Strong human sales people, sales forces, be it broker or tied agents, multi-tied agents, single tied agents, help a lot. So again, Spain, France, Italy, great. UK with a strong aggregator channel, probably not as good, I guess. Also, profitability in UK seems to be a bit lower than in other European countries. So that's probably, I'm not saying it's impossible. It's probably a bit more difficult because you lack the many people with insurance authority over customers because the UK got rid of it due to regulation issues. And so they've left it to the aggregators mostly, I guess. So probably a bit harder there. Other than that, I'd say, yeah, it should work in many countries. And what we've learned, because we also entered Poland, what we've learned is there's still a couple of markets out there with strong cycles, right? I mean, the older guys remember this in Germany, Switzerland, France, Italy, and so as well, where you had 7 to 12 year cycles, where like during 5 years, the motor was especially strong in motor. The motor business was hugely unprofitable because everybody tried to undercut each other to win market share. And then either the regulator or common sense actually told the people, hey, we need to get up with prices because that's killing us. So, typically then prices went up, and then for another 5 for whatever years, it was very profitable. And, some Eastern European countries still have that strong cyclicity, which also I think you see in the commercial business. If you look at commercial lines, you still see that cycle. I mean, I think now it's getting better, but for the last 3-4 years or so, from what I'm not an expert, but from what I've heard, commercial lines were in the red zone, so fairly unprofitable for most insurers. So if you have strong cycles, you need to watch out with the switch tariff because obviously you undercut or at least match the price of the competitors. So you probably, you're fully with the cycle. So in Poland, when we entered Poland last year or this year with WeFox, it was in a down cycle. So I think Poland is ready to increase prices in motor. And I would not go at the bottom of the cycle. I would not enter a country. So Poland this year, probably not the best idea. Poland in 2 years, I guess probably a good idea.
And just a question, which I forgot, kind of coming back to the channels, and fully agree with the insurance authority there. Having said that, one of the downsides, if you like, of a personal driven sale is that you have in P&C recurring commissions, right? So for the longer and so there could be a counter argument to be made, which is to be validated with that counteracted, that if the other channels, like bank assurance and employers or direct and affinity, if they wouldn't require as much of the ongoing commission to make back their own customer acquisition costs through bundling or bundling largely, they could potentially try to counteract their lower insurance authority with higher prices or better value, potentially, because they could pass part of that on to create a stronger insurance proposition.
So lower prices, yes, absolutely. I mean, basically, if you play the discount game, and again, you can play different games with the switch tariff, but let's pretend you play the discount game, saying I give you the same coverage or a bit more, but definitely at a lower price. Let's say 5% less price or so. Then obviously you have to be able to afford the 5%, right? You can afford it by several things. The line of business is hugely profitable. If it has a combined ratio of, let's say, 85, and you undercut the price by 5, you end up with 90% combined, which is still good enough for most competitors. B, through strict underwriting guidelines and adherence to those, obviously, you can, exclude the unprofitable segments and become, lower your loss ratio compared to the general market because you rule out the unprofitable lines of business. You could also be cheaper in terms of distribution costs, sales cost, or admin costs. Admin costs is only a very small percentage of the premium, so it takes a lot to become 5 percentage points better in admin costs. But yes, I mean, if you have a disadvantage in sales costs, let's say you're paying 10% more to your sales channel than others pay to their sales channel, then it's very hard to undercut the competitors' prices by 5% because it's 5% plus 10% you pay more to do sales. So it needs, you need to look at it holistically and come up with a solution for yourself.
Yeah.
Given your personal situation as an insurer, what can I afford? Maybe you need, if you pay 10% more to your distribution channels than everybody else, then I guess you won't be able to play the discount game. You would need to play the quality game. Those 10% should theoretically translate into a higher insurance authority, meaning this channel should be able to, sell at higher prices than the channels that are 10% percentage points cheaper. So hopefully that's the case. So then I would turn the switch story into, yes, you pay 5% more, but your coverage is much better. I'm here for you. You know me from, I don't know, the tennis club or soccer club or whatever. So again, I mean, this is very flexible. Switch isn't, I mean, it can be handled very, very flexibly.
Yeah, you basically have a lever of money,
yes,
to distribute, and a process that gives you access to that money, which is economically sound because it doesn't force either the consumer or a person, an agent or broker to sit down for 20 minutes, 30 minutes with an unsure outcome whether the price is better, and then maybe getting 40 euros per year on commission, right? I think it's that. What I was kind of alluding to was a little bit, I've had a few conversations with some of these employers who need to hire lots of drivers right now. Getting drivers or getting cleaning is really tough. It's really tough. And I've also learned that these drivers usually don't stay on for 40 years. So getting a VW pension scheme is not really going to work for Gorillas or Flink or Helping, right? So here, this could come really interesting because they don't care about making money on this. They care about creating an incentive scheme to get drivers in and potentially saving them 20 to 30% potentially at the same coverage. So I think it's really interesting, both in its applicability, but also from a scalability point of view, because you as an insurer, you construct it once, and then you can kind of multiply and configure it rather than having to ultimately redesign for each channel, which is, I think, gives it a nice flexibility boost, and a scalability boost as well.
I agree. And also for the other channels, I mean, we all play the cross-selling game, right? And that's the holy grail. I mean, if you're a broker or tied agent, the tough thing is to win a customer. And that typically means customer acquisition costs, CAC. Right? You need to do advertising, you need to convince the customer to come to you and bring his, her portfolio to you, sit down with you and, allow you to ask him or her a million questions on his private life and personal life. So, I mean, CAC is what everybody fears, but is inherently in the business model. And then it's all about cross-selling. The more products you cross-sell to this customer that you've spent a lot of CAC on, the better it is. And so, as I said, if you save 90% of your time selling a switch product than selling any other product of your insurance company or any insurance company, you probably don't need the full provision or commission percentage, because you save 90% of the time, and in those 90% you can cross-sell 9 other customers. So you probably don't need the maximum set of commission ratio.
No, absolutely. And I think if you have a backend that doesn't need to hard code 25% over all slides, and potentially a agency contract that also doesn't have that set in stone, you might as well kind of let your distribution partners decide on how much they want to earn. Wouldn't be the first time, it's called wholesaling. Might not be a bad idea. Some MGAs do it, obviously, and I think it's getting that last mile pricing towards the end of the customer, but also having kind of them taking the full hit on it, rather than only kind of driving down even risk premiums. Now this sounds really great. And that's what I'm so excited about it. This sounds really great, but let's face it, I haven't been in the trenches with you. So what are some war stories from the trenches? What mistakes or pitfalls are there? And you don't have to spill the beans here, obviously, but maybe what are some cautionary tales, some things for people to think about that might not be that obvious, that you've learned in over the last hell of a ride, the last 2 years?
Yeah. I mean, there's a lot we've learned, obviously, and a lot to be learned probably still. I think a common misunderstanding, because you don't use actual pricing, is that it is very easy to use and not really insurance work, actuarial work. But again, you have to look at this thing holistically. Sales, admin costs, loss ratios, selection mechanisms, underwriting rules. It's quite some math, and it took us a while to basically almost being able to predict the profitability of Switch, although you don't know where those Switch contracts come from in terms of previous insurer. If you get your setup right, in terms of what it costs you to administer this, because your straight through process ratio and the number of processes per whatever technical, non-technical process that come up per customer, and your sales commission obviously, and through your underwriting rules and by playing the market and segmentation, you basically can predict the result. When we did it first time, it was basically a trial and error. I mean, we could have gone terribly wrong. We could have ended up with a terribly loss ratio and combined ratio. And then after year one, we actually found out, whoa, that's highly profitable. It was hugely profitable, much more profitable than any other tariff for new business we had out there. And so in the second year, we made the exercise to kind of try to predict what happened in the second year, right before the second year, because then we've learned, okay, if we cut out this market segment, then it reduces loss ratio by 2.3 percentage points or so. And then, before the second year, we basically calculated this should be the outcome of this tariff, right? Given the market loss ratio and everything, and we basically hit it by plus minus 1 percentage point. So, but you need to really do your math, understand the mechanics, the flow of this tariff. And then you can really predict it. And it's not a bet anymore. Like many people, when we brought this tariff out, many people is like, that's gambling. You could end up with 150% combined, right? And we were like, yeah, you're right. We only had four months to bring out a Switch motor contract. So yes, we didn't do that homework in the first year. And we're like, yeah, it could be, but it's WeFox, so we have money to spend. So it could happen. The second year, we actually went to the reinsurer who reinsured this, which is in the first year obviously was a tough thing to do because we couldn't tell them it's not going to be 150% combined. Second year, basically, we did the math. We went with a clear calculation, said, what we expect is this combined ratio. And they were like, how the fuck would you know? Because you don't know where the business is coming from. Because we did the homework. We know exactly what underwriting rule contributes how much to the loss ratio. We know exactly our admin costs, and we know exactly our sales costs. So you do the math. That's going to be the outcome. They still didn't believe us. They still had set some precautious measures, but we hit it basically to the spot in the second year. So I think third year now will be okay. We believe you guys because it's pure math. So that's one thing. The other thing, and that probably doesn't come as a surprise, but we're telling you, but when you're in the midst of it, obviously there's as many times there is a trade-off between ease of selling and profitability. So the more granular you define your underwriting rules and cut out little segments that are unprofitable in the market, obviously the better the result, your combined ratio will be. But as sales needs to ask the questions to determine the underwriting rules, you better limit this to 3 or 4 questions and not to 60, because then you don't save the 90% of the time again for sales. So you need to find a good middle ground, right? And I think it's very hard for a lot of C-levels in insurance companies to kind of give up potentially on profitability to make the sales story as much easier to sell. So this kind of it's almost like a lever, and you can gradually adjust it. And we had to learn this. I mean, we went in very easy on sales, which would probably, when the reinsurance said, we could become even more profitable. Yes, we could, but it makes it harder for sales. The second year was a bit harder to sales. I think we added 2 more questions or so. We gained again on profitability. We hit our target profitability. But yes, that's a lever you have to think about, and to adjust this lever is a matter of experience a bit.
But I think that's the interesting thing, right? You make it predictable. You make it so that it is a lever, and it must be a controller's dream.
And reserving actually. First year reserving actually is like, what the fuck should I reserve? I don't even know where these guys are coming from. Could be they all come from the cheapest shit insurer in the country. What reserves am I there to? IBNR, calculate the IBNR on a non-actuarially calculated tariff where you don't know where the customers come from. And so second year, when together with the pricing actuaries, we said, this is the target profitability, we would be very, very disappointed or surprised if we wouldn't hit that plus minus 2%. Then reserving is very easy. So it's a dream. If you know your business, it's the dream of a reserving actuary and the controller, obviously, yes.
So why hasn't this caught on then? When we started this talk, you said portfolio transfers, switching is not something novel. Why do you think this hasn't been done like you guys did it? And why? Some people copied it. Why do you think not more people copied it yet?
It takes a couple of bold decisions, and I think we all, having worked in the incumbent industry, we all know that, careers are not made by bold decisions that turn out positively, but more by but avoiding the big mistakes, right? And if you start with this switch tariff generation that we've started with, without any experience, without any knowledge, without being able to predict what's going to happen with the loss ratio and the combined ratio, it's a risk for your personal career, right? And I'm just guessing. I'm glad enough not to be part of the incumbent industry anymore, but I'm guessing that most C-level insurance executives would probably rather stick with the known and rely on the actuaries, because then they can finger point to the actuaries and say, hey, sorry, it was a mistake of the actuary, not my mistake. Then taking the bold decisions of not taking an actuarial price, a technical price into account, but relying on the actuarial work of the competitor insurers, because if that goes wild, and would end up with 100%, 50%, then it's your career, right? So it does take a couple of bold decisions, which, being a young competitor, Julian has raised a lot of money, so we were able to try things. People would not hold me accountable for mistakes, but rather for having not tried hard enough, kind of thing, right? So it was a unique position we were in, or WeFox still is in. And I'm not blaming, CEOs from Allianz, AXA, Generali, whatever, because it's eventually, it's if you started at the same point as we started at One Insurance, it's very unsure. That most people when we started, actually, we had a lot of bad press, like from the other CEOs of other insurance companies saying, you destroy the market, you're going to end up with 200% combined, you're going to kill your business, you're going to kill your insurance company, but the regulator will have to scrap you off the wall. So there's a lot of negative things, and I think if you want, and there was a probability that this will end up very, very badly for us, because we hadn't done the homework that we could have done, that we could do in the second year. Now, who's taking this chance, having a career and being paid, I don't know, 2 million euros or so as a fixed salary? I don't blame the guys. You probably need to be in a WeFox One position to take that bold decisions.
Yeah, I think it's about incentive structures, right? I think it's about smart people following incentives, and the incentive structures are really not for that. And I think period. But I think what you've mentioned is actually really interesting, and which is why I think from an incumbent's point of view, the best thing that could happen if you are looking where to look is InsurTech, especially scaling InsurTechs, because someone else footed your R&D bill.
Yes, true.
That's great. And it's now what I guess, because I'm kind of in both worlds. I still find it fascinating that this doesn't resonate, right? It's great. This is free lunch, basically. But no, I get it. I think it's exactly that. It's having the right incentive structure, and then also it working out. I mean, I remember when my dad and Christian, when they started OCC, and I think classic car insurance, and I think risk number 20 was like a 300,000 or 500,000 Ferrari.
Yeah.
If that had crashed, that business would have been closed down. Everyone would have told them this was nuts, that you shouldn't insure them, that this was like horse betting. And that was it. And so sometimes things just need to work out. And, I think you've said it, it's kind of victors write history, right?
Yes.
And then in retrospect, everything seems so obvious. And everyone kind of gets the bold move story. But I guess it feels a bit different when you're having to make these decisions. But yeah, I think it's for everyone who's looking at it with open eyes. I think this can be a tremendous opportunity.
I agree. I mean, you have to deal with it, though. I mean, you have to really dig into it. You have to probably look at the differences between season 1 and season 2 in WeFox, and you can probably get out a couple of learnings. And still, it's I mean, as an insurance company, One Insurance didn't even have to publish the switch tariff loss ratio or combined ratio separately from other tariffs in the same line of business. So as we've also written business through aggregators, which was highly unprofitable, the average line of business doesn't really look that good. So you need to have inside information, basically, or ask a lot of questions to GDV or regulators or whatever, to find out how profit really was. And you have to kind of follow the learning curve of WeFox in the second year, or now even the third year, which is now taking place. So you can do it, but you need a lot of effort, and you need to admit that a small little player like One Insurance has done something different and obviously better, so well that you, as a 130-year-old company, need to copy it. So I think it's also swallowing your pride a bit, I guess.
Yeah, and maybe to kind of wrap this up, and we've already alluded to some, but from your discussions, both internally when you set it up, but also in the recent kind of weeks, what were some misconceptions when encountering, when discussing this with insurance executives that you've encountered?
I mean, one we already talked about is like, it's easy, everybody can do it. Well, then try, right? I mean, try it.
I've heard people have, and they stopped it. So
yeah, people they tried it, without any underwriting rules, without all the thoughts that went into our tariff structure, underwriting structure, without having done the end-to-end view on their tariff, and the mathematical calculation of where will this end. And then it's typically not a good idea. I mean, you can be really wrong. We were lucky in the first year, and then we were analytical in the second year and third year. So it's not that easy. Just because you don't have a technical price for every customer doesn't mean you don't have to put a lot of work in. I mean, the work that we've put in the second year in calibrating the underwriting rules according to small little segments in the motor or homeowners LOB line of business that are unprofitable, and to cut them out, to increase the loss ratio by 0.5 percentage points or so is tremendous. And it takes a lot of reverse engineering of thousands and thousands of tariffs, building a huge database, terabytes of data. So it's not that easy. If you think it's easy, you typically end up with high loss ratios and high combines. If you want the kind of loss ratios that One WeFox has in the second year, you need to do your homework. Mm-hmm. And it's as much homework, at least, than building a technically priced tariff, I can tell you. The other thing is, I've had is doesn't that make us look like a cheap shit offerer, right? And that's why we've I think both stressed this is a very, very flexible tariff. I mean, you can make your salespeople tell any story. I mean, from, I actually waive my commission, dear customer, in order to give you a 20% discount on your homeowners or whatever, up until, yes, it's 10% more expensive than your last contract, but it has a lot of quality features also. I mean, everything in between is possible, right? And I mean, it's a story you and your salespeople want to tell. We decided for the story, being a very digital player and having some cost advantage in the back office, we decided to tell the story we're 5% cheaper than the competition. But you don't have to tell that story. So, I mean, if that's all you can think about, then again, you haven't done your homework. I mean, then you haven't understood the whole potential of the switch tariff, because the switch tariff can tell any story. It can be double the price of today when it has tremendous features in there, right? So then you haven't understood the switch tariff concept yet. And I think the third misconception is, is that wouldn't the regulator be against that? Because wouldn't they force you to have a technical price? And my answer is, obviously we've discussed it with our regulator, with different regulators, actually different countries. And we said, look, this is not, the price isn't coming out of the blue. The price is coming from an actuarially calculated tariff of a competitor, which you guys supervise. So I hope it's okay. We have underwriting rules, and we put a lot of effort. Actually, we put more time into defining the underwriting rules to cut out the unprofitable segments than another typical insurer puts into coming up with a actuarially calculated technical price. So, and by the second year, we said we actually can predict the combined ratio and the loss ratio. I mean, my experience is there's no problem with the regulator. I mean, there might be in some countries or states with some lines of business, but in general, this is not, I mean, you don't roll the dice, right? I mean, you do your homework. And again, we could predict the combined ratio plus minus 1 percentage point at the beginning of the year for the entire year. So you're not, I mean, if you communicate that openly to the regulator, the regulator will know this is not dumb stuff, right? This is those guys know what they're doing, and there's no danger, and that's the worry of the regulator. There's no danger of this company going bust because the switch tariff doesn't go right. They know exactly what they're doing, and this also doesn't mean they rip off the customer, because that's the two worries of a regulator, right? You rip off the customer and you go bust, and the customer stays there, and the claims are not paid. So neither of the two, especially if you play the 5% discount game, neither of the two is the case. You save 5% for the customer, so there's no customer misbehavior or mistreatment, and you know exactly what you're doing, and there's no risk at all of going bust with this.
And are there, operationally speaking, do you find, is it kind of business as usual, or are there certain specificities that you then would have to convince your different claims and ops departments to get a handle on in order to manage switch?
Of course, there's specificities. You ask much fewer questions than with an actuarially calculated tariff, but you do ask one specific question that nobody has ever asked before, not even an aggregator, right? And that is, what are you paying today, right? That's a question that typically not even an aggregator asks, except they want to do a comparison like, hey, your saving is X or so, but typically they don't ask the question. So it is different in the underwriting process. It's again, in theory, you end up with a zillion of different tariffs that you have to take over, because typically you guarantee the customer that he or she doesn't lose any coverage compared to his or her last contract. So that means, if you think it through, you end up with a million of different tariffs that you need to regulate for and administer for. There's workarounds, obviously, so you need to be smart again, in working around this. Luckily we found that way to work around this even in the first year, but it took us a while to kind of figure out how can we prevent from ending up with a million tariffs, old tariffs, maybe an AXA tariff from 1984 or so. How can we prevent this? Because nobody even knows. That's only on paper. Nobody even knows the coverage of this. So there's a couple of things, and then obviously, if you want to make life even easier for sales, you find a way to even reduce the number of questions sales have to ask to the customers. So, what we've done, for example, is we scanned or took a picture, mobile phone picture of the invoice, the previous invoice, and we could read a lot of information is on there that we can read out from OCR, optical character recognition. And then, sales doesn't have to ask those questions to the customer anymore. So you even shorten the process for sales. That's obviously something you need to take into account and put into your systems. And yeah, there's a couple of processes. Like, if, let's say, the customer tells you, my price today for motor insurance is £400, and turns out later it's £800, then you have to reissue the contract, because obviously the customer lied to you. There needs to be a phrase in the contract that says, if you lie to me and I find out later, then I'm allowed to adjust the tariff. So you need to send him or her new tariff. Same with the salesperson. If you find out, even worse, that the salespersons and or the customer have lied to you in an underwriting question, like, are you even eligible for a switch tariff, then you actually have to cancel the contract. So there's a couple of detailed nitty-gritty things that you have to take into account. You learn it along the way, or you listen to you and me, and we tell you. But yes, I mean, there's a couple of differences in ops and IT between the switch tariffs and normal, regular, actuarially calculated tariffs.
Yeah, and I think one of the big benefits is obviously, and that's always the question, it's kind of starting with someone who's been there, done that, reducing the cost, the time it takes to figure something out, but also the externalities of things not working out in a culture where things have to work out. It's just how much iterations and chaos do you want to throw into the fray whilst you're ramping up your guide wire or whatever. How much fun is that? So I think there's reasons why you decouple certain things, and I think for everyone listening here, what our offer from Ollie and I is, reach out, let's have a chat, ask us any questions. We do have an agenda, and our agenda is to sell you something. And what it is to sell you growth out of a can. It's, work with us. We want to build a white label processing MGA that helps you manage these switch products and helps you, put some gas onto, not gas on the street, put, the metal on the, what is it? Put the pedal on the metal.
Yeah.
It's a bit late now. But, come talk to us. And, if you feel you can do it by yourself, good luck. I think that's the beautiful thing about this market. I think insurance seems like it's easy to copy, and yet it doesn't quite work out. I think as a lot of market entrants have experienced, but reach out to us. We're really looking forward to talking to you and answering any questions you might have.
Absolutely.
Awesome.
Cool.
Ollie, thank you so much.
Great being on the show.
And speak soon.
Speak soon, absolutely. Bye, everybody.
Bye.